No amount of capital flowing into a Bitcoin ETF is going to create any more Bitcoin. What we've got is 900 Bitcoin a day. And around April 16th to April 18th of this year, we're going to go to 450 Bitcoin a day. This will be the halving, but it will be the single most consequential halving in the history of Bitcoin. You're talking about, it's the equivalent of someone coming in the market saying, I'm going to buy $8.5 billion of Bitcoin a year for the next 4 years, $23 million a day at the current price, guaranteed.
Today, we are joined by Michael Saylor, who shares his upcoming prediction for Bitcoin and why he's bullish in 2024. The upcoming Bitcoin halving event, set for April, and the recent approval of the Bitcoin Spot ETF will add even more demand in the next few months. Saylor states that he's not surprised at the success of BlackRock so far, since coming into the crypto space. Thanks to BlackRock's significant influence, there's an increasingly strong belief that, in the not-too-distant future, we'll see the approval of even more Bitcoin ETFs. This marks a historic milestone for the Bitcoin community, a development that many have been waiting for well over a decade. The green light for such an ETF carries profound implications for the world of cryptocurrency and serves as the gateway for substantial institutional investments, drawing interest from sovereign wealth funds, major corporations, and even governments. Saylor envisions that this development will pave the way for large corporations to incorporate cryptocurrencies into their balance sheets. Let's get right into the latest interview with Michael Saylor and why Bitcoin is poised to revolutionize cryptocurrency in 2024. Don't forget to share your thoughts and comments down below, and leave a like if you enjoy the content we do here.
I'm not surprised they're successful. I expected them to be very successful. I think there's 10 years of pent-up demand. They're the most eagerly anticipated development in Wall Street. This is like Bitcoin coming public. It's like the IPO of Bitcoin, except it's like 10 companies simultaneously taking Bitcoin public. Because Bitcoin's a commodity. It's not a security. So the idea that that BlackRock and Fidelity and Grayscale and Bitwise and ARK, they're all taking Bitcoin public at the same time is a big deal. The fact that I'm not surprised they're successful as ETFs because Bitcoin's the apex ETF. The other ETFs are based on oil, like let's say commodity ones, oil, gold, platinum, silver, palladium, market baskets of commodities, natural gas. All of these things are defective as investment assets because physical commodities aren't scarce. Physical commodities can be manufactured in any amount with additional capital and know-how. So ultimately, the best of them is the gold ETF. But if a bunch of money flows into a commodity ETF, that just actually fuels capital into commodity producers. They just dump that commodity on the market, the price gets held down. So commodity ETFs were never that great an idea. On the other hand, comparing these Bitcoin ETFs to the S&P index, the biggest ETF and maybe the biggest development on Wall Street was the launch of the SPDR, SPY, in 1993, about 30 years ago. And the idea that you could create an ETF that represented a market basket of 500 stocks, that was big, and especially that was big because that came along at a point where people had lost faith in the currency as money, as a savings technology. And so they were trying to figure out what is money, and actually an entire generation of people picked the S&P index as money, right? How are you going to store your excess cash for a decade or longer? Not a checking account, not a savings account, not a bond, but the S&P. So the S&P became money, and that ETF became the monetary index. And that's why today, amongst, that's the most successful ETF. If you look at SPY and all the S&P index type ETFs, they have most of the capital in them. But the problem with those ETFs is that stocks also are not conservative. So if I increase the price of the stock by a factor of 10, you're getting more equity. Or if I take hundreds of billions of dollars of cash and I buy the ETF, like S&P ETF, the ETF has to buy all 500 stocks pro rata, which means they're going to have to go buy Tesla and Apple and Google and Meta at any price. They're price insensitive, even if they're overpaying. So when they buy it at any price, what they're doing is they're creating more equity because they're encouraging those companies to issue more stock. And then, of course, this is common sense. If the price of your stock doubles, the employees in the company with stock options, they sell the stock, right? They sell the stock option. When they sell the stock option, you put more stock on the market. So the price creates supply. There's a price supply elasticity there. And that's the same as you have with commodities. And it's the same thing with bond funds. When you have capital flows into all those other asset classes, you create supply of that asset. They're not scarce. Bitcoin's unique because no amount of capital flowing into a Bitcoin ETF is going to create any more Bitcoin. What we've got is 900 Bitcoin a day. Now, that's a huge amount, but more importantly, that's a huge demand-supply shift in the year when the demand via the ETFs has jumped by a factor of 4 to 10 times the daily supply. So what you have is institutional capital entering, and then you have the supply getting cut in half.
The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Saylor asserts this journey is just beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Saylor highlights this being a significant development in the financial ecosystem. He also suggests that BlackRock, under the guidance of Larry Fink, will lead the charge in other institutions obtaining regulatory approval for a Bitcoin ETF. This move, he contends, will underscore Bitcoin's enduring relevance as an asset and its potential as a hedge against currency devaluation.
What happened with these ETFs? Well, the approval of the ETFs was a pretty concrete endorsement of Bitcoin as an asset class by the regulators. And anybody who's thinking about banning Bitcoin or not approving Bitcoin ETFs, they're now out of consensus. So it really flipped the global consensus from, well, maybe it's too good to be true, maybe it'll be banned, maybe it won't be banned. The approval of those ETFs meant that it doesn't matter who wins the 24 elections. It's taken the future of Bitcoin out of the hands of the president. It's taken it out of the hands of the next head of the SEC. It's taken it out of the hands of most regulators in the world. We pretty much opened Pandora's box or crossed the Rubicon. It's very concrete at this point. And it was uncertain, right, before. And so that's a very big piece of regulatory clarity. What happened next is it's created a positive dynamic where now I think you're seeing pressure to approve ETFs in other places in Asia. You'll probably see Hong Kong spot ETFs. You'll probably see them get approved in any country where people are on the fence. It used to be that you paid 2.5%, to hold your money in Grayscale. And all of a sudden now you're paying 1.5% at Grayscale, but you're paying 25 basis points at BlackRock, or you're paying 20 basis points and even 19 basis points. Not only did that bring down fees for institutional holders of Bitcoin in the US, it also put pressure on international fees. So you actually saw a rippling effect, and people with European or Canadian or other spot ETFs in the rest of the world that had 100 basis point fees or 150 basis point fees, they're having to bring down their fees because otherwise the capital will flow out of their instrument into the lower cost instruments. So let me convert the math here. If you have an infinite duration asset and you're going to put, if you're going to put money in it, then the difference between 2% fees and 25 basis point fee is losing 37% of your money. You understand? Like it's like I take a third of your money. Okay. So if you're a Bitcoin investor Having low fees means you invest $1 million and you get to keep the $1 million. Having high fees mean you invest $1 million and you lose 300,000 of it over the course of 20 years. So those low fees are, well, where is that going to manifest itself? It's going to drive the price of the asset up, right? First of all, because the people that own the asset aren't losing 1 or 2% of their money every year. But second, because there are a lot of people that they will either invest $1 million in it or nothing, right? So if I like it, I'll just invest $1 million. If I don't like it, I'll invest nothing. So you start to see money flowing from gold into Bitcoin, from the S&P index into Bitcoin. And so that's a big deal. So the launch of the ETFs, it's been very successful. This is the ideal type of asset to put into an ETF wrapper. It's definitely it's the global asset. It's the biggest brand. Everybody knows what it is. It's actually the best thermodynamically sound investment. It's got the best historic performance. And of course, it doesn't have the entire array of risk factors that a company has or that a bond has. It doesn't have credit risk. It doesn't have corporate execution risk, and it doesn't have currency devaluation risk. And it doesn't have the physical risks of real estate. It's not going to ever get hit by a bolt of lightning. There's not going to be a tornado. It doesn't have maintenance decay. It doesn't have property tax risk. It doesn't have the political risk, right? Ask yourself the question, you got $1 billion and you got to buy some real estate in Africa. Where do you want to invest $1 billion in a building? What country? What city? Where? Or you can buy Bitcoin. And of course, so you can see this is a higher quality thing. What was Bitcoin's number one liability coming into 2024? It wasn't the risk. It wasn't the thermodynamic risk factors. It wasn't the technical capabilities. The number one risk factor of Bitcoin coming into 2024 was a government would ban it. But see what just happened in January? The opposite, right? So most of the FUD around Bitcoin is, oh yeah, it's too good to be true. And because it's too good to be true, the government's going to hate that you bought it and they're going to take it away from you. And with the approval of these ETFs, it was the government of the most powerful country in the world, the United States, which is actually the leader of financial regulation. I mean, whatever the U.S. does will influence Singapore, Australia, New Zealand, all of the EU, even Hong Kong, even China for that matter, and all of South America and all the African regulators. So everyone's looking to what happens in the United States. This was a very powerful signal. So that was a bullish development.
Saylor challenges the conventional macroeconomic metrics, asserting that these metrics are often manipulated to paint a specific narrative, like labor statistics and inflation figures, which are selectively measured to create desired effects rather than reflecting the true state of the economy. In this context, Bitcoin emerges as an alternative, detached from the manipulations of the conventional economic sphere. Saylor also highlights that established corporations like Apple, Amazon, and Google will use their established relationships acquired over decades to swiftly acquire substantial amounts of Bitcoin through a spot ETF, bypassing the cumbersome processes involved in procuring the actual commodity. This disparity underscores the transformative power of cryptocurrencies in traditional financial institutions. Michael Saylor underscores the importance of embracing digital currencies as the economic landscape is changing rapidly, and urges investors to leverage Bitcoin's potential to secure a more prosperous financial future. What do you think about the latest interview with Michael Saylor? And how do you think Bitcoin's trajectory in the coming months will impact the crypto market and the world of investing? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.